Welcome to the Opening Bell Report.
Okay, I want you to picture the California gold rush for a second. It's 1849.
Right.
Everyone is rushing west, panic in their eyes, pickaxes in hand, just desperate to find that one life-changing nugget.
It's the classic image, isn't it? Opportunity and just total chaos.
Exactly. Now, fast forward to the stock market over the last, 18 months? That gold, that has been artificial intelligence.
No question.
And the pickaxes, well, those have been the chips, the GPUs. If you bought the shovel sellers, the NVIDIAs of the world, you didn't just get rich, you built a dynasty.
Oh, without a doubt. The chip trade was the defining trade of 2023, maybe even 2024. It was the easy bet.
But here is the question we are wrestling with today, and it's the reason we have this specific stack of reports on the desk.
Okay.
What happens when you have millions of pickaxes, but the mine is locked? What happens when you have all the chips, but you literally can't turn them on?
You should go with the power wall, the physical limit.
Precisely. Today, we are doing a deep dive into what a lot of these analysts are calling phase 2 of the AI trade. We're moving away from the trillion-dollar chip giants, and we're looking at the plumbing. Specifically, the massive amounts of energy required to run these things.
It is the single biggest bottleneck in tech right now. You can print silicon way faster than you can build a power plant. That is just a fact of physics.
And to navigate this, we're looking at a really specific and I'd say arguably high-risk case study. We've got an analysis report here on a company called NUAI.
New Era Energy and Digital Inc.
That's the one.
This is a fascinating one because, honestly, it's flying totally under the radar for most retail investors.
It's trading right around the $5 mark. But the reason it hit our desk is because it jumped 26% in a single day recently. The volume just went through the roof.
Which usually means one of two things. Either someone knows something, or the narrative is finally catching on. Institutional money doesn't usually wake up and buy a microcap by accident.
So our mission today is to strip this down. We need to understand this whole energy plus AI thesis. Is it real or just a bunch of buzzwords?
Yep.
We need to look at NUAI's specific pivot from drilling oil to hosting servers. And because we value our listeners' portfolios, we need to be brutally honest about the risks.
Yeah, we need to put the warning label right on the front of this one. This isn't Microsoft.
So let's start at the macro level before we zoom in on the stock itself. Why is energy plus AI the headline here? Why not just more AI? I mean, we have electricity. I plugged my toaster in this morning. It worked just fine.
Sure, your toaster works.
Yep.
But let's look at the scale. Think about a standard data center, say, 10 years ago. It was storing your emails, hosting some websites, maybe streaming a few cat videos, low-intensity stuff.
Right.
Now look at an AI training cluster.
Okay, so how much more are we talking?
The power density required is, it's exponential. A standard rack of servers might draw 5 to 10 kilowatts. An AI rack with the newest NVIDIA chips, you're talking 40, 50, maybe up to 100 kilowatts per rack.
Wow.
And get this, a single ChatGPT query takes about 10 times as much electricity as a simple Google search.
10 times. So if everyone switches from Googling to asking AI, the grid just melts.
Basically, yes. The U.S. power grid simply wasn't built for that kind of concentrated load. And here's the real kicker. It takes 5 to 7 years to upgrade a transmission line or build a new substation. The regulatory hurdles are a complete nightmare.
But you can build a data center shell in, a year?
18 months easily. So you have these massive server farms ready to go, billions of dollars in hardware just sitting there, and the utility company is telling them, take a number, we can probably hook you up in 2029.
So you have a Ferrari with an empty gas tank.
Exactly. And that is where this energy plus AI thesis really comes in. The market is hunting for companies that can bypass the grid, companies that have their own power source already permitted and ready to go.
Which brings us to NUAI, New Era Energy and Digital. Now, looking at their background in the report, they weren't always a tech darling. In fact, they seem like they were the complete opposite.
Far from it. This is the really interesting part of the pivot. NUAI started with its roots deep in traditional energy. We are talking oil and gas exploration.
So hard hats, drilling rigs, fossil fuels, not exactly the Patagonia vest crowd you'd find in Silicon Valley.
No. But in this specific market dynamic, that old world asset class is actually becoming the new secret sauce.
Okay, explain that to me. Because usually when I hear oil company pivots to tech, I just think desperate attempt to stay relevant. How does owning an oil rig actually help you run an AI chatbot?
It's about a concept called behind-the-meter power. If you're a traditional energy company, you have access to fuel, you have land, you already have the permits to generate power.
Right.
If you can put the data center right there, literally at the source of the energy, you don't need to wait for the utility company to build a transmission line out to you.
You're cutting out the middleman, and the grid is the middleman.
Precisely. And that is what NUAI is pivoting toward. They're transitioning from just selling the energy to the market to using that energy themselves to power digital infrastructure.
The report calls this vertical integration, which sounds fancy, but in this context, it's basically just owning the cow in the butcher shop, right?
That's one way to put it. In this context, it means owning the power generation and the data center operations. It's considered the holy grail right now because it secures your costs and, more importantly, it guarantees your uptime. If the grid goes down, you don't care. You are your own grid.
Okay, so that's the theory, and theories are great. But a pivot is just a PowerPoint slide until you actually buy something. And this is where the report flags a major news drop.
The acquisition of TCDC.
Texas Critical Data Centers. This was not a small purchase. The price tag was $70 million.
Right.
I want to pause on that number. $70 million. We'll get to NUAI's size in a minute, but for a small company, that feels like a bet the farm moment. It's a huge chunk of change.
It is a massive statement of intent. You don't spend $70 million if you're just dipping a toe in to see if the water's warm. This is them planting a flag. TCDC isn't a concept. It's physical infrastructure. They're buying capacity.
And what exactly are they getting for that money? Is it just a building with some fancy air conditioning?
They're getting the infrastructure that allows them to plug in those high-performance GPUs immediately. They're buying speed to market. Building this from scratch would take years of permitting and construction. Buying TCDC allows them to enter the conversation now while the demand is at its absolute peak.
So they're buying a shortcut.
Essentially, yes.
Yeah.
And in a land grab, which is what the AI infrastructure build-out is, the person who gets there first often wins.
Okay, but I have to play devil's advocate here. It's easy to announce a $70 million deal, but can they actually digest it? We see companies make bad acquisitions all the time.
That is the primary execution risk, and the report doesn't shy away from it. Integration is hard.
Right.
They're an energy company trying to run a tech stack. The report is optimistic because TCDC comes with existing expertise. They aren't firing the staff. They're acquiring the brain power too. But you're right to be skeptical. This isn't automatic.
Let's talk about the company size, because I think this is where the whole opportunity versus risk calculation really happens for you, the listener. The report has a big red stamp on it, microcap.
Yeah, we should define that so everyone is on the same page. NUAI has a market capitalization, the total value of all its shares, of roughly $293 million.
And to put that in perspective, for people who usually only trade the S&P 500, Apple fluctuates by $200 million every time Tim Cook sneezes.
It's tiny. It's a drop in the ocean.
So why does the report even compare them to companies like Core Scientific or Applied Digital? Those are billion-dollar players. Is that a fair comparison?
That's the catch-up trade argument. The logic goes like this. Core Scientific and Applied Digital are doing the exact same thing, mixing infrastructure with power. The market values them at billions because they are further along. NUAI is doing it, but the market values them at less than $300 million.
So the gap between those valuations, that's the potential profit.
Exactly. The report argues that NUAI is mispriced. If they successfully integrate TCDC, why should they be worth 1/10 of their competitors? The thesis is that as they prove they can execute, the market cap will expand to close that gap.
It's an arbitrage play. You're betting that the market is wrong about the price of NUAI because it hasn't noticed the pivot yet.
Or it hasn't believed the pivot yet. That's the key distinction. The market is a show-me mechanism. It wants proof. That 26% jump we saw,
Yeah.
that's the market starting to believe.
Let's talk about that jump, because 26% in a single day is, well, it's fun if you own it, but it's kind of scary if you're just watching it.
It's volatility. Pure and simple.
The report says the stock closed around $5.49 with a high of $6.32.
And that intraday range tells you a lot. It tells you there's a battle going on between buyers and sellers. But the volume, the number of shares traded, that confirms the buyers are winning right now.
Now, the report brings up a strategy involving the $5 mark. It calls it the golden zone. Can you decode that? Why $5? Is there some mathematical magic there?
It's psychology. Human beings just like round numbers. We just do. When a stock falls to 4.99 cents, it looks cheap. When it hits $5, it feels like a solid floor. Traders will literally place their buy orders at these round numbers.
So it becomes a self-fulfilling prophecy?
Largely, yes. The report suggests that if you are interested in this play, you don't necessarily chase the spike while it's hot. You wait, you see if it cools off, and test that $5 support level. If it holds 5, that's your potential entry.
And what about the upside? The report talks about blue skies if it breaks 632. That sounds poetic, but what does it mean in technical terms?
Blue sky breakout is a technical term. It means there's no historical resistance. Think about it. If a stock used to trade at $10 3 years ago, there are people who bought at 10 and are currently losing money.
The bag holders.
The bag holders. They are just waiting for it to get back to $10 so they can sell and break even.
And that creates selling pressure, a ceiling.
Exactly. But if NUAI breaks its recent highs, there's nobody waiting to sell.
Sure.
Everyone is in profit. That creates a vacuum where the price can move up very, very fast.
Momentum feeding on momentum?
Correct. But,
Yeah.
and here's the wet blanket I have to throw on the fire.
What?
It works both ways. When a microcap falls, it falls fast. There is no safety net.
Right. This isn't a stock where you put your retirement fund. This is not set it and forget it. This is the Vegas money part of the portfolio.
Absolutely. The report calls it a speculative play for a reason. You are betting on management's ability to pull off a complex merger of two very different industries.
I want to circle back to the financials because I'm still stuck on the money. We talked about the acquisition cost, but how does a small company like this actually fund it? Are they issuing more shares? Because that dilutes existing shareholders. That's a hidden cost, isn't it?
It is. And that is a great catch. The report doesn't get into the deep details on the debt structuring, but usually, with these microcaps, they fund growth through equity offerings, selling more stock, or some kind of high-interest debt.
So if they issue more stock to pay for the data center, my slice of the pie just gets smaller.
Yes. Dilution is the enemy of the microcap investor. However, the counterargument is something called accretive growth.
Which means?
Think of it this way. Would you rather have 100% of a grape or 90% of a watermelon?
I'll take the watermelon.
Exactly. If selling 10% more stock allows them to double their revenue by buying TCDC, then the whole pie gets bigger faster than your slice gets smaller. That is the bet you're making.
Right.
You're betting they're building a watermelon.
Let's zoom out a bit. We've looked at the chart, we've looked at the deal, but I want to go back to this energy plus AI narrative. Is this just a short-term trend? Is this the flavor of the month? Or is this a structural shift in the economy?
I truly believe this is structural. We are seeing the convergence of two massive industries. For the last 20 years, tech and energy were separate worlds. Tech was in the cloud, energy was in the ground. They didn't really talk to each other.
And now the cloud needs the ground.
Desperately.
Yeah.
You know, we've seen major tech CEOs, Zuckerberg, Altman, openly stating that power is their biggest constraint. They are talking about building nuclear reactors. They're talking about fusion.
But fusion is, well, it's always 20 years away.
Always. Exactly. So in the meantime, in the next 3 to 5 years, the solution has to be finding existing power and repurposing it. That is why the NUAI strategy is so timely. They are trying to invent a new energy source. They are taking existing assets and plugging computers directly into them.
It's a bridge solution.
It's a very lucrative bridge.
But what about the other risks beyond just it's a small company? What about the tech risk? Does the world actually need this many data centers? Are we in an AI bubble? What if nobody uses these chatbots next year?
That is the trillion-dollar question. If the AI hype cycle crashes, if companies stop spending billions on training these models because they aren't seeing a return on investment, then the demand for these data centers just evaporates.
And NUAI is left holding a $70 million building and some oil rigs.
Right. If the gold rush ends, you do not want to be holding a warehouse full of shovels.
So for you listening, if you're considering this, you have to believe in the longevity of the AI build-out.
You have to believe that compute demand will continue to outpace power supply for at least the next few years.
Yeah.
If you believe that, then the energy plus AI thesis holds water.
And within that thesis, NUAI is positioning itself as a first mover in the microcap space.
The report really stresses that urgency. First mover advantage. The idea is that once the big institutional money, the Wall Street banks, the hedge funds, really figures out this trade and does their own due diligence, they won't be buying at $5. They'll be buying at 10 or 20.
So the trade-off is you get in early at a lower price, but you take on the risk that the company might stumble. Or you wait until they are proven, but you pay a premium.
That's the classic investor's dilemma. The report suggests the risk-reward ratio right now at this $5 level favors the bold. But again, position sizing is key. You don't bet the house.
A ticket to the show. That's how the report phrased it.
Exactly. It's a ticket to the show.
Mhm.
Just make sure it's money you can afford to lose if the show gets canceled.
So let's wrap this up and synthesize what we've learned. We have NUAI,
New Era Energy and Digital.
a company pivoting from old school energy to new school AI infrastructure.
Leveraging a $70 million acquisition of Texas critical data centers to vertically integrate their operations.
They are trading near a key $5 support level with a market cap under $300 million, making them a tiny fish in a very big pond.
A volatile, high-risk, potentially high-reward fish.
And the broader tailwind is the undeniable shortage of power for AI data centers.
The macro trend is their best friend right now.
So, as we sign off, I want to leave our listeners with one final thought. We've talked about energy companies becoming tech companies, but let's flip it.
Go on.
If power is the constraint and money is truly no object for these big tech firms, are we going to see the Giants, the Microsofts, the Googles, the Amazons start buying up these small energy players. Are we going to see a world where Amazon isn't just a cloud provider, but a utility company?
That is the logical endgame, isn't it? If you can't buy power from the grid, you buy the company that makes the power. We're already seeing Amazon buying nuclear power from Talon Energy.
It feels like we're watching the start of a massive consolidation. NUAI might be a hunter right now buying TCDC, but they could easily end up being the prey.
And being acquired wouldn't be the worst outcome for shareholders, honestly.
Very true. A buyout usually comes with a nice premium.
It certainly does. It's a wild time to be watching this sector. The walls between these industries are just crumbling.
Well, that is plenty to chew on. Keep your eyes on the chart. Watch that $5 level, and remember, in the gold rush, make sure you know who's selling the shovels.
And check if the shovels actually work.
Exactly. Thanks for diving deep with us today. We'll catch you on the next one.
See you next time.
Don't forget to like, share, and subscribe for more.